Hello and welcome to BloombergQuint. The Reserve Bank of India and the Monetary Policy Committee, which reviewed monetary policy today, left all key rates unchanged. The repo rate stays at 4, the reverse repo rate stays at 3.35, and the stance remains accommodative. Now, you're probably wondering that if there's been no change, what are we discussing? Well, we're discussing whether the RBI did the right thing. Joining us to talk about some of that is Saugata Bhattacharya, Chief Economist at Axis Bank, and Arvind Chari of Quantum, both familiar voices here on BloombergQuint. So thanks so much for taking the time to speak to us. Saugata, I'm going to come to you. Your note landed in our inboxes yesterday, and you said close call, but balance of probability tilted towards a reverse repo hold. So you got it right, but do you think they've done the right thing?
Well, to continue on that, I also said that a close call. So it's not that we were completely certain about this, but given the balance of probability. But we also said that, I think to our mind, this was the time. Actually, we have been saying this from the last policy as well. So this was the time to start normalization. Now, this begs the obvious question: why? That we are saying that this needs the start of a formal normalization. You've seen governors saying that we have actually taken up the de facto effective repo rate, reverse repo rate up to 3.87, etc. So what's the need? If the rates reflect our policy stance, so why would you need to change the rates? We tribe of economists keep on talking about the Reserve Bank falling behind the yield curve, falling behind the credibility curve, etc., falling behind the curve. What exactly does that mean? Why would we say that we need to probably have started on the formal normalization process? Remember that India's external financial conditions will be very, very tight going on. All the other global G10 central banks have signaled very aggressive rate hike trajectory. So I think the normal channel that we used to talk about, the channels of transmission, the spillovers of global policy tightening, those probably will remain active. If not the commodities price channels, at least the portfolio flows channel will be the key source of transmission for those segments. But together with this, I think the biggest problem that we have is, yes, for the banking system, the effective rates have gone up to close to where the repo or the reverse repo should have been. But there is this significant chunk of system liquidity that's still priced at or below the reverse repo rate, all the non-bank liquidity in the system. And this has the potential of introducing distortions in the system and also clogging the signaling channel for RBI's monetary policy. I think that's primary reason, besides all the other economic and financial fundamentals that remain. So that's probably the key concern that we have with the delay of the normalization process.
Arvind, your first thoughts, would you have also wanted them to act given both macro fundamentals, liquidity fundamentals, and what's happening globally?
I have to admit I got them wrong. I had a fairly, I won't say hawkish, but I had a fairly calibrated stance in terms of, they should also talk about changing their stance from accommodative neutral. I felt the policy statement and the governor's comments needlessly dovish. And I say that for the following 4 reasons. One is, if you look at the global background, the global commodity prices went up, came down, and surging again, and doesn't look like it's going to come down. So that is the backdrop that you see. As Saugata said, the financial tightening by the G10 central banks is going to have some impact through either through the trade channel or through the confidence channel, as we call it, from the portfolio side. The third is we are not in a crisis. So to keep crisis level rates of reverse repo, high liquidity, and not even indicating that these are crisis level rates and it will have to go, and there's no path given for that. And the fourth, which is my most crucial point, is that when the government takes on the mantle of supporting growth through fiscal spending, not only for last year, this year, and till FY26, the RBI's priority should move, given the fact that we think the GDP growth activity and economic level has come back to trend levels. We are not at 4%. India is not growing at 4%, which was pre-COVID, and maybe we're growing at closer to 6.5. If you so that output gap, whatever they talk about. And the government is spending for that. The government is expanding its balance sheet, 11% of GDP in put together center state PSUs. That's a significant amount of spending. And then, so on balance, the RBI should have moved to prioritizing, say, financial stability and inflation. And which is why we thought that not having even a guidance about when they will hike, will they even make this small change in the reverse repo rate hike, which everybody was expecting. And that's what I felt they were, I think, needlessly dovish.
I'll come back to the growth and inflation side. I have a couple of questions just on some of the technical, Saugata. So there's a fair amount of confusion, right? You have this fixed rate reverse repo, which is at 335, as Arvind said. That's the that was an emergency level. You're saying that doesn't really matter because our effective rate has already moved up because of the VRRR auctions. You're also saying that we're moving to a liquidity framework where the 14-day VRRR auctions are going to be the main liquidity management tool along with the VRR auctions. So the importance of the fixed rate reverse repo has reduced even further. Yet they don't want to move on that because they're saying that's linked to the stance, which it hasn't been so far. I mean, we're all over the place.
No, I mean, there's a certain consistency to this that given the reducing significance of the fixed rate overnight reverse repo, so why should that matter to you? I mean, whether it be 3.35% or whatever, why should that matter? So because our effective, the signaling rate, the 14-day VRRR, we are at the de facto, well, I mean, the usual reverse repo gap level, or maybe even at the repo level, or exactly at the center of that gap. So, I mean, given the reducing significance in terms of liquidity management of the overnight reverse repo, that's just a number. I mean, it's not actually true, as I mentioned. I mean, because there is a significant amount of market turnover that is still getting priced at that reverse repo. That's 2-3 lakh crores turnover. That's not chump change. I mean, it's still there, and this creates distortions. So the other point to note in this is that the RBI's economy, if I might move one step beyond this thing, that the stance, the dovish stance, etc., is consistent with what they are projecting in terms of growth and inflation, that trade-off dynamics, both of which seem to be a little, to my sense, on the conservative side. So both from a demand perspective, that look, if their internal analysis does project that growth prospects remain weak, potential output gap still remains very negative, which as a consequence, the inability to pass on even higher input costs, which might not happen, all of that into end user prices. So if that remains, then there is a case for continuing with this stance. But that still runs that risk of that spillover from global central banks, because if there is a certain amount of weakness that is perceived, that offshore investors perceive in the system, that might also create trouble. And then on top of that, if this weakness persists, particularly with regard to MSME aggregate demand, etc., and the important role of credit in this system, so we will still try to keep our credit our costs of deposits, costs of bank funds, and therefore the cost of loans, the price of loans relatively stable. That's also a plausible story. That didn't come out very clearly in the statement, but that's also a factor to consider. So to a certain extent, if the story, the implicit story of continuing weakness in aggregate demand in the potential output gap, then you will probably have to keep a relatively accommodative, easy monetary policy. I'm not very sure that that's the case. And particularly, as Arvind mentioned, I mean, given the global risks to inflation, price stability, given the way the crude has moved up, likely to remain high, metals, commodities prices are likely to be high, with global recovery gaining steam, that will also add to aggregate demand, global demand into the system. So the price complex looks to be relatively on the risk to that price forecast will look to be high, not the balanced risk that the MPC statement says. So that, I think, is my biggest concern, that if there's an underlying demand problem, then we need to sort it out. But that's, again, something which will impact our growth, which will, again, have consequences for financial stability, etc. And then on the other side, if demand recovers, that will also add to price pressures, then the price stability issue comes in. That's the perception that probably needs to be managed.
Okay. Arvind, I'm sorry to persist with the weeds of this, but I still think there's something to be said here, because you're not voting on reverse repo in the MPC.
Yes.
Now you're linking it to the accommodative stance because the governor very clearly said that, with this stance, we didn't think there was any reason to move on rates.
Yeah.
But you're messaging that the actual effective rate is something that is being determined entirely outside of this framework. I just feel that there is some confusion, at least in understanding what they're using as their key tools here.
I agree with you, Ira. There is a lot of muddled thinking, especially the comment that we didn't think of changing the stance because the reverse repo rate and the liquidity is operational. And I think that complicates the matter. You already had an issue where the MPC has votes only on the repo rate, and they has standing only on the repo rate and the inflation, and they have this stance to portray what they want to do with liquidity, but they don't have any say on liquidity. They don't have any say on the reverse repo rate. And now saying that the reverse repo rate is kind of linked to the stance change. I think that is some amount of muddle, and I think it is needless. Also, as Saugata said, the weighted average bank LAF auctions may be at 380, 390, but the bulk of the non-bank mutual funds, insurance companies are lending in the TREPS market, and that TREPS market is now not stable. It's actually very volatile. So 7-8 years of stability in the money market rates. I know it's not wide. I mean, it's 335 to 4, but still, why would you want to bring in volatility in everyday money market, especially the time when no one knows the actual liquidity. It's only the RBI which knows what's the daily liquidity availability in the system. And every market participant is reacting to what auctions do they announce, where do they cut off, and when are they going to do it next, right? Why would you want to do all that, especially when you're okay with the fact that overnight weighted average rate or reverse repo is at 380? Yeah. Why not just get the reverse repo at 375 and narrow the corridor to 25 basis, which has always been, and that's the liquidity framework document that they put out 2 years back mentions that, right? 25 basis points of the corridor between repo, MSF, and reverse repo. I think they should do it. Maybe they are wary about the fact that it will be a rate hike, but there is already a rate hike, and there's volatility. Money markets are volatile today. Why would you want to do that? I didn't understand that.
I'll move away from the weeds and now come to the macro, Saugata. So you already mentioned some of your thoughts on the growth side, but at 7.8%, still lower than what most people would have anticipated. Is much of this concern coming in from the private consumption side, to your mind? You mentioned MSMEs and some risk coming in from there, but broadly, given that government capex will remain high, so perhaps that will be some support. Exports, unless there's a sharp turn in the global recovery, perhaps that will be okay as well. So is the bulk of the concern on the private consumption side?
I think you're right. That it is. And remember, the MSME segment that we talk about, particularly the micro and the small, is very interlinked with this consumption, because these guys are the producers, yes, the proprietorships, etc. But it is this segment which is also the consuming class. So if their output doesn't increase, their consumption, neither does their consumption. So that link is very, very with the MSME segment. So the MSME segment needs to be supported, needs their output, their balance sheets, etc. need to improve. So that's a key concern. There's no doubt about that. On the growth side, yes, exports are unlikely to be a big engine of growth. China is expected to slow down. You've seen the IMF forecast, significant drop in both growth. WTO says a very aggressive drop in global trade. So the trade engine is unlikely to be anywhere close to the growth. Presumably from the 400 billion that we expect this year, there's still likely to be there's some upside. But you're absolutely right that it is probably this consumption segment, which, as Governor mentioned, is at more or less at the pre-pandemic levels. But this is also another concern that I have. Governor is talking about the real levels of consumption. Real levels of consumption are still below the pre-pandemic levels. But on the other hand, if you see the nominal growth, over the last 2 years, we've had a 30 trillion rupees, 30 lakh crores worth of increase in nominal growth, from 200 odd trillion rupees lakh crores to 230 this year, and probably in FY23 another 30, given the growth rates that we are talking about. So that's a significant amount of money. And it is this. Of course, a lot of this is driven by inflation, by price increases, etc. but that's an amount of consuming power that's supposed to be there, is somewhere in the system. My fear is that this is resident in the top deciles, couple of deciles, or the top couple of quintiles in the system, and it's not percolating down to the lower and lower middle income households. And this is what is the next level of the policy problem, the policy dilemma that is likely to emerge. So on the other hand, on the one hand, this concentration of consumption, income power, disposable income, wealth, etc., will actually drive growth, consumption, the formal levels of consumption. But the lower levels, in terms of the sustainability, what Governor talks about in terms of broad-based, durable growth and recovery, is this which is the problem that is likely to emerge. And this is where the role of the fiscal situation, the role of the fiscal levers, the fiscal stimulus becomes very important.
Arvind, the story, I mean, that some of this unevenness has to be addressed by the fiscal, not the monetary. But what's your take on growth, and how different is it from the RBI's?
We love the fact that the government finally last year got out of its conservativeness on fiscal and expanded fiscal, because at the end of it, India is a growth story, and growth solves a lot of our problems, be it poverty, be it incomes, be it creating infrastructure, both hard and soft. So it is good to see that the government is focusing on spending, and they're focusing rightly also incrementally, largely on capex spending. That is what drives potential growth, right? Over a period of time, as the investments, if they are done, spent efficiently, on time, by the center and the state, it will have its own multiplier impact. What we didn't like this time, as with last time, was that balance was missing, which is what Saugata was pointing out in terms of consumption. So we still believe in a budget of 30-40 lakh crore that the government spends, another 2-3 lakh crore in some form of income support. It could have been a direct support. It could have been cut in taxes, cut in oil price tax. Maybe that's coming. It could have been a tax holiday for MSMEs for a 2-year period. It could have been a bunch of things to address the pain segments in the economy, which is informal labor, informal enterprise, people who have lost their services industry. So I think they could have had some direct support, because the capex spending takes time. And in India, shovel-ready projects are that much not available. Like you're already seeing, even this year, only 40% of the capex spending has actually been spent. So you're only 3 months to go, or 2 months to go, and the December data showed that. So it takes time for the multiplier trickle down impact to come. There was a need to support that. Maybe RBI is kind of taking that and saying that, okay, consumption is going to remain lower, and maybe that's why their numbers are about 7.8, if I remember correctly, whereas consensus is between 8 and 8.5 for FY23. We believe that the global story is a lot stronger. We've already seen, despite whatever challenges India faced on the container front and availability front, exports have picked up, both in volume terms and in value terms. And that is a good driver for private capex and for growth. The availability of capital, despite you might see short-term outflows, but across all asset classes, we've seen inflows from foreign investors, diversifying away from large markets, or just looking at Indian growth perspective. I think from that perspective, we think that growth we will be surprised in the upside. But for some short-term impacts that we might see from oil prices and from some Fed tightening activity, which would be on the capital flows, I think the growth is, we are in the cusp of a economic revival, and the government spending kind of addresses that, the fact that it can continue. So maybe the RBI's numbers are slightly conservative.
We are hearing that word a lot these days between the budget and the RBI. Everyone's sort of taking the conservative route. Saugata, on the inflation side, is the disconnect mostly likely on the input price front? The RBI governor did not answer a question on what level of oil prices they have taken into the inflation projections, but it could be either on the commodity price and hence pass through of commodity price front, the disconnect, or it could be on aggregate demand adding to inflation pressures. Am I right on that?
Yeah, absolutely. Completely on the ball on this. So that's my fear, that risk, more than growth, it's that inflation risk which is a little worrying as far as I'm concerned. So, one are the supply pressures. So oil, crude, as Arvind mentioned, there might be a sense that and the Revenue Secretary did, in fact, talk about this, that the growth projections on taxes excludes excise. So I have a feeling they're planning that they have factored in the potential need to be able to cut down on the excise taxes on fuel. So, I mean, from that excise front, I mean, I think they are effectively de facto taking a significantly higher average price for Brent crude, Indian crude basket. But and there are other factors too in terms of the metals commodities prices. You've seen aluminum, copper prices increase. Although how China pans out over this next year, they have already started their fiscal stimulus program. So it's unlikely that China's growth will be allowed to go down significantly. They will put in prices, which again will add to the overall pressures in the system. Overall, from the global perspective, as recovery takes hold, obviously, I mean, much of the developed market recovery will become manifest in services more than commodities, more than consumer goods, etc., merchandise goods. So that is likely to keep some of the metals pressures down. But overall aggregate demand will be added to the system. And in India, on top of this, again, the pent-up demand that we have seen coming into, so, I mean, even if the consumer electronics and other items don't factor in that much, this will get translated into more of these services, the contact services demand as the economy opens up, the restrictions go. And that adds to the CPI basket. So that impacts the CPI basket. Now, the critical question is, given our perceptions, our mutual perceptions of the state of aggregate demand, what is the ability of various end user consumer industries to be able to pass on these input costs? My own sense is the input costs, other than crude, other than oil, will not be as high. The pressures will not be as intense as it was in the past. The logistics problems will also begin to start going away. But the critical question is, what is the level of inherent demand in the end user segments that will allow many of these companies, FMCG, paints, housing materials, etc., to be able to pass on? We've done some preliminary numbers. I mean, it's very difficult to come out with some of these demand without in the absence of data, which again is emerging as a major problem in trying to understand, to calibrate the extent of aggregate demand in the system, the potential output gap, etc. But if you just look at these 2,000, 3,000 companies that we track, the listed companies that you and I track, if you try to get them out into an input, intermediate, and final output, across segments, I mean, obviously the impacts are different, but you do see over the course of the last 4 or 5 quarters that there is a tendency for many of these end user segments to be passing on rates. It's come down in the Q3 quarter, but my sense is, again, it will start increasing in a little bit. So I think from the price perspective, there is a risk of inflation beginning to take hold. I'm waiting to see the household inflation expectations numbers in the RBI publication.
All right, that's very we'll bother you for that research to read it in greater detail. A couple of last questions. Arvind, so from a bond market perspective, I think the dovishness obviously came as a relief. But that is sort of false hope in some ways, because the pressure starts from April and there was no clear indication as to what they'll do. All the words were very calming, because the governor said we'll manage this in a non-disruptive way. We'll signal our comfort on yield levels, etc.
The bond market may have been one reason why they were so dovish as they were, in the sense that the financial conditions, the bond yields, the longer and medium term, have increased quite a bit, not only after budget, but also pre-budget, right? Since December 15, which is when the Fed turned the cycle, right? We've seen a significant increase in yield. So maybe that could be one reason why they wanted to kind of calm down and temper the market. The fact that they have not given any guidance on reverse repo rate hike, forget about stance change and then repo rate hike, would mean that the market will now price in that they have longer to deal with low rates, and hence the spread and the yield curve becomes more attractive, especially in the short and medium tenor, because that was a segment which is more sensitive to RBI removing liquidity, as well as the stance change will first impact the shorter end. And you've seen a significant drop in government bond yields across the short to medium tenor. And I think that the rejoice there is a lot higher. The longer tenor will go back to looking at oil prices, at US treasuries, and whatever happens in the weekly auctions, whether it gets cancelled, whether it gets devolved. I think that demand supply play will start. Given that government seems to have slightly higher cash balance, the RBI has at least till March or till the next auction, they have space to cancel and manage the bond yield. So the larger issue is if the hiking cycle itself is delayed, and then there is a general thing that okay, even when they hike, what's the terminal rate, right? Will the RBI try to keep repo rate at 5% as against 6%, which has been our historical average, right? Hopefully with low food inflation and managed, will that happen? If that happens, then it has a significant impact on how the shape of the yield curve moves, right? In terms of if repo rate as a terminal repo rate next year is 5%, 10-year bond yields or 15-year bond yields at 7% already seem attractive. There are supply risks. There is the oil risk, there is a treasury risk, the US Fed risk. But that I think the next move for the market will be when they do it, when do they indicate this change in stance and hike, and then questions on what the terminal rate will be. I think that what will drive the bond market. For the shorter tenor, we were hoping that the rate hiking cycle starts, which would mean that short-term money market funds, banks, short-term fixed deposits will start moving up and savers will get slightly better returns. I think they'll have to wait. Looks like this is going to be a delayed hiking cycle.
Okay, last quick word from both of you. I'll stay with you, Arvind. What's the bet now? When do we see a hike? Do we see a repo rate hike as the first step, or do we see reverse repo still be the first move?
I think the sequence has to be a reverse repo rate hike, which would have happened. But sequence will be reverse repo rate hike, change in stance to move to neutral, saying that okay, we are confident about the growth recovery. Government is doing it. And we may have to focus on inflation, especially if oil goes to 100.
When is my question?
I think so because they've been very clear about, which is what I misread. They were very clear that it will be very telegraphed, it will be calibrated. So between now and the next policy, maybe we should hear that. And in the next policy, closer to the next policy or the next policy, they will start announcing, and I think they will give a framework of the sequence of when they'll do it. Reverse repo rate hike. I think stance change. I think stance has to. You can't remain accommodative if you're not in crisis, right? You would have to move to neutral. And
so then, at least one policy away, you're saying?
Easily one policy away. Because if it's telegraphed and calibrated, it means one policy and more. So in the next policy, we'll hear.
Last word to you as always.
Fully agree with Arvind. That absolutely. But one caveat. I mean, that the narrative that is often put out, that this is the reverse repo rate. I mean, it doesn't need to be in the policy. It can be an off-policy review. Typically, central banks don't take off-policy actions. That's always a little unusual. I mean, unusual circumstances. So I don't believe in that. So I completely agree with Arvind.
And they've linked it to the stance now. So
absolutely.
So when do they move and what do they move on?
So my bet is April. April they will probably need to do that full 40 basis point hike, then June stance change, and then October, December, whenever the repo comes in at that point in time, unless things go horribly wrong.
Okay, I'll leave it at that. Although it's a different discussion, which Arvind sort of mentioned as to what the terminal rate would be, but don't have time for that today. Thank you both, Saugata and Arvind, for joining us on this interesting discussion as always.
Thank you, Ira.
And thanks for watching Bloomberg.